For the year ended 31st March 2017, so statement of comprehensive income. So we have W Limited. So W is the parent, S Limited, and F Limited. So as we can see there, no issue. Additional information, W Limited bought 60% holdings in the equity shares of S Limited on 1st April 2016. The purchase consideration agreed at shillings 900 million, of which shillings 600 million was paid in cash. The balance was satisfied by the immediate issue of a 5% bond at par. S Limited net assets had a fair value of shillings 1,400 million as at 1st April 2016, represented by equity share capital of 775 million and retained earnings of 625 million. Okay. I hope if you add the 775 plus 625, it comes to the net assets, because whenever there is variation, you really kujanga ile fair value uplift, the revaluation. So I hope 625 plus 775 should be that 1,400 million for the net assets. It was decided to apply the proportion of net assets method to calculate goodwill on acquisition. No impairment loss on goodwill arose during the year ended 31st March 2017. Okay. W Limited sold its entire 60% equity. Entire, please underline the word entire. Underline the word entire. They sold, so W sold its entire 60% equity holdings in S. In S on 31st March 2017 for shillings 1150 million in cash. No entry had been made to reflect this transaction. We are going to make the entries. W Limited owned 90% of equity shares of F since incorporation. No goodwill arose on this acquisition. There were no retained earnings in existence as at the acquisition date. Okay. During the year ended 31st March 2017, W sold goods to F for 15 million. These goods were sold by W Limited at a markup of, it was 50%. The typist, I don't know what happened. 50% on costs. 50%, that is 50% on costs. 3/5, that is 3/5 of these goods remained in the inventory of F Limited as at 31st March 2017. An amount of shillings 4.3 million, hapo pia kuna shida, rekebisha hiyo. An amount of shillings 4.3 million remained outstanding. W Limited in respect of these goods as at 31st March 2017. So we are just going to calculate the unrealized profits, no issue. Number 4, on 1st March 2017, F declared an interim dividend of 9 million. W has recorded its share of this dividend as income. Okay. No other dividend were declared by the group companies during the year ended 31st March 2017. All expenses and gains are assumed to accrue evenly throughout the year. No new equity capital was issued by any group company during the year ended 31st March 2017. Interest on the 5% bond was payable in arrears. No payment had been made, I think it had been made for whichever. Fine, no problem. Required. 1, the gain or loss on disposal of the shares in S Limited on 31st March 2017, 4 marks. Consolidated statement of comprehensive income for the year ended 31st March 2017, 10 marks. So of course, we have to analyze the periods so that we don't mess up. So let's analyze the period. The year is ending. Check when the year is ending. That should be at that point. So the year is ending on 31st March. 31st March 2017. 31st March 2017. So for it to end on 31st March 2017, it means it must start on 1st April 2016. 1st April 2016. So let's analyze the two subsidiaries, S and F. So W bought 60% of S on 1st April 2016. So 1st April is when S was acquired. Then in note number 2, W sold its entire 60% equity holdings in S on 31st March 2017. Here, they sold it at the end of the year. So S disposed. So S was disposed on that date, exactly at the end of the year. Okay. So S was disposed exactly at the end of the year. Good. Then number 2 again, paragraph 2. W owned 90% equity shares of F since incorporation. So since incorporation is Kitambo. So that one was acquired long time ago. So just tell me how we are going to consolidate for P&L, profit, stock loss. How will we do consolidated profit, stock loss? So tell me W, of course W must be in full, parent must always be in full. How about these others? So P&L, you need to tell me W plus, can you tell me how we are going to consolidate for that? I'm seeing reflection there. So P&L, consolidated profit stock loss will be W plus I'm waiting for a book complete for me, that because that is the question. When you get it right, you are good to go. We are going to take W. Hiyo unafikiria ndio correct. That thing unaona unafikiria, so just bring it on. Whichever you are thinking is the correct one. Nancy, wewe umeandika W peke yake ama ulikuwa unaendelea. Massive W plus F plus S. So W plus S plus F. So you mean in full. That is true. Because S was there for the whole year. Yes, very full. So in this case, if it's disposed at the end of the year, it means we were entitled to income for the whole year and also expenses for the whole year. Tunauzia jipange now from next year. So W plus S in full plus F also in full. So there is no apportionment. There is no apportionment. There is no apportionment. The same case will apply to the balance sheet. Even balance sheet you check in full. Then the adjustment for disposal will now take place from next year. I don't know what examiner was really checking there, but I think alikuwa anaangalia meambia student they disposed entire so that students will end up leaving S. If it is disposed at the end of the year, then there is no much effect. The only item which will come up is just checking the gain or loss, which you need to bring in the financial statement, which is required on 1. So before we check the gain or loss, remember, The gain or loss, we have to, goodwill will be required, even the net assets on the date of disposal will be required. So I want us to calculate goodwill. In the books of S. In the books of S, they said there was no goodwill. I read it somewhere. We saw it somewhere. They said there was no goodwill on acquisition of F. So let's just calculate goodwill on acquisition of S. So working one, goodwill on acquisition of S Limited. In my program highlights, today morning we were just supposed to finish up the disposal, which this is the last question. Therefore, I'm not much under pressure. Can you calculate for me goodwill? Just try. I like when you try. If you try and you get the goodwill, you can just draw for me that answer. Then we compare. Then we see where maybe we made a wrong. Can you try and tell me how much is the goodwill? I'm giving you 3 minutes. Try on your own to calculate goodwill. If you get answer, don't shy off. Usiseme wacha ningoje mwingine. Tungekuwa physical, ungekuwa naangalia ya neighbor. Sasa hii neighbor amekuwa mbali. Tuma. Hilda amesema liwe liwalo. Arusha yake 60 million. Massive 60 million. I'm waiting for two more. Two more, then we confirm. Let's also sometimes try. It's good. Jenga 60 million. I know you people can't lie. How can you get the same? There is no way you can get the same wrong answers. So if they're the same, it means you people are correct. Vera 60. Let's confirm. So you will take here purchase consideration. Purchase consideration. In note 1, the purchase consideration was 900 million. Then, when the fair value million, of which 600 was paid in cash, the balance was satisfied by immediate issue of 5. That is not our problem. This is Nangalia the total. The total purchase consideration is 9. Wherever they're paying it, years than you have. S Limited net assets had a fair value of 1,400 million as at 1st April 2016. So in this question, the noisemakers, NCI were not stated at fair value, so it means we are going for partial method. So partial will be 60%, so you less. So less net assets, 60% of 14. What is 60% of 1400? What do you get? 60% of 14, you're likely to get what figure? 840. So that is 840. Meaning that goodwill is 60. Correct. That was good of us. So yes. There was no impairment. If there was impairment, I would have subtracted, but there was no impairment. All right, let's move. I want us to learn kidogo. What else do I want you to calculate for me before we proceed? No, you will calculate for me unrealized profit using note 3. But for now, there's something I want us to check before that. I want us to check out the net assets of S Limited on the date of disposal. When it is going to be applicable when calculating the gain or loss. So we have to check net assets on this date. So working through net assets on disposal of S Limited. You have to check their net assets which they are going to sell. And when we talk of net assets, we are talking of ordinary, retained earnings, share premium, revaluation. Mostly those are the 4, but it's not a must, the 4 must be there. It's not a must. All right, so we are set. So you check ordinary share capital. Ordinary share capital, of course, that one will be constant. So the weight is in note 1. They said, where? Represented by equity share capital of 775. Check that note 1. You will see ordinary share capital was 775. And retained earnings was 625. Retained earnings was 625. Now, what you do is this one here. Check at the beginning of the year, the retained earnings is 625. You know, it was acquired on 1st April. I don't know what came in their mind. They acquired in April, then by the end of the year, wakauza. In fact, this subsidiary was held for sale. It was just purchased, then maybe wafanya a small adjustment. I think that was the main intention. Because why do you acquire subsidiary at the start of the year and at the end you dispose? So it was 625 at the beginning. Then to get the retained earnings at the end, you add the profit they made for the year. So check P&L. Check P&L of S. So P&L of S, profit after tax. Profit after tax, you will be able to see 90. So retained earnings 90. There is 90. Then when you check that P&L keenly, if you check P&L keenly, there is gain on revaluation of property, 122. So revaluation, there is revaluation of 122. Therefore, on the date of disposal, I hope you're seeing where I'm getting the figures in the P&L. Profit after tax for the year is 90 plus revaluation of 122. Then ordinary share capital was 775. So retained earnings is not going to be correct. That is wrong. You know 90 is for the year. Yeah. So retained earnings will be 625 opening plus 90 so that we get the closing. Sorry for that. So this is 625 plus 90. 625 plus 90 is how much? 625 plus 90. That is 715, yes. So the retained earnings on the date of disposal was 715. Can you add? That is the net assets on the date of disposal. So people are getting 16, 12. So I'll hold it there. So now we can proceed to determine gain or loss on disposal. So let's answer question Roman 1. For Roman 1, they are saying the gain or loss on disposal of the shares in S Limited. You know, that question is not complete. Because so markers will decide on what to do. You know, gain or loss on disposal, we normally calculate two of them in the individual books and for consolidated. If you remember the question for yesterday, we were directed by the examiner specifically to calculate gain or loss on disposal in the consolidated profit account. The examiner was specific in the consolidated. The other one we did, they were also specific. They wanted both gain or loss on disposal individual, then again they require us to calculate the gain on disposal, which is consolidated. So this one, they are not telling us which one. So to this effect, I want us to do the two of them in the individual books and also for consolidated, so that the examiner will decide which one will make them happy. So let's start with individual books. So Roman 1, gain stroke loss on disposal. Individual financial statements. Of course, individual financial statements of the parent, individual financial statement of W Limited. Parent is the one disposing of. So you just calculate in the books of the parents. All right, so you check the proceeds. You check the proceeds. Proceeds on disposal. Proceeds is the amount you received when you disposed of that company. So we were told in note number 2, they sold the entire for 1150 in cash. So they sold it for 1150 in cash. Then you less the investment disposed. You less the investment which you have disposed. So this one is always very simple. So the investment disposed, you just check how much you invested in that company, which is the purchase consideration. We had invested 900. So it is 900, but we have disposed the entire. Entire means 100%. We have disposed the entire investment. So we had invested 900, but we are selling the entire amount. So you multiply by 100. So the 100 is there to represent the word entire. Entire means you have sold everything. Don't say 60%. Yes, we know we invested 60% in that company, but when you dispose entire, it means you are selling off your 100% investment. So this is 900. So in the individual financial statements, we gained. There is a gain on disposal. Gain on disposal of how much? The difference. The difference will be how much? $250. So this one we gained to 50. So in this case, I know when the examiner is not specific, they can decide. Wanaweza decide kama wanafunzi amefanya ya individual, mark and award the marks. Kama amefanya consolidated, mark and award the marks. So I think whichever, but if they are specific now, that is okay. So in this case, the question can be, it can go to a whichever you do, individual or consolidated. So let's go to consolidated. But me and you are in the mind of the examiner, the consolidated one attack. So right there, gain stock loss. Gain stock loss on disposal. Consolidated profit stock loss accounts. Like that. So proceeds on disposal, that one remains the same, 1150. There is nothing here like the net assets or the interest retained. We are not retaining anything because it is an entire disposal. So there's nothing to be retained. So you less goodwill disposed. Goodwill was 60. So the entire amount is being disposed. Also, the net assets disposed. Net assets disposed. So the net assets disposed, we are getting 1612, the one which we have just gotten here. But sorry, for the net assets, we have to be keen. Sorry, you can't bring the 1612. You know, for the net assets, that was the net assets of that subsidiary. But the net assets parent was not controlling everything. What they had, what they were entitled to, is what they disposed. So for the net assets, they will take 60%. They were entitled to 60% of the net assets, 1612. Then whatever you will get, they disposed 100%. So times 100% entire disposal. So 60% of 1612. Net assets you cannot bring in full. You know goodwill already. When you check goodwill computation, net assets we had already multiplied by 60. So this one is the one you are supposed to capture. So 60% of 1612 will be how much? 60% of the 1612. How much is that? 967.8, somewhere there. 967.2. Therefore, the total, there is no MCI to be subtracted because already it is full method, it is entire disposal. So kuna mambo ya subtract MCI. So 60 plus this is 10 what? That is 7, 2. At least I fikiria to me. How much? 60 plus that one comes to what? Point something. 0.2. 1027.2. So this is 1027.2. Therefore, on consolidated, still you will capture again of how much? Again of something 0.8. Nancy, 122, 122.8. It's not amount to be the same. As simple as that. So now we want to go to consolidated P&L, but before we go to consolidated P&L, I want you to use number 3 to calculate for me the unrealized profits. You are the ones doing for me that. So unrealized profits on inventory. Unrealized profits on inventory. UPI. So I want you to tell me how much is the unrealized profit. There were some breakups in that note number 3. I need to repeat for purposes of those who are not there when we were reading. It said, check note 3, please. Check note number 3. During the year, ended 31st March, W sold goods to F for 15 million. These goods were sold by W at a markup of 50% on cost. So please, that is 50%. There was some, I don't know what is that, but that is 50% on cost. 3/5 of these goods remained in the inventory of F as at 31st March 2017. An amount of shillings 4.3 million remained outstanding to W Limited in respect of these goods. You mambo ya outstanding wachana na, you calculate and realize profit based on the other information. So can you try, then give me the answer. Try out. There is no harm in trying. Once you get unrealized profit, you help me with the answer. Hilda, unrealized profit 3 million. 3 more. From 3 more. Hata uko na answer different, we are going to confirm. Jenga, 3 million. 2 more. Nancy 3, Brian 3. So siwezi tukufe tu na hiyo 3. Because as I normally say, there is no way you can get correct wrong answers. Correct wrong answer have a similar correct answer, yes. So unrealized profit, you take profit margin. Here they gave us markup of 50%. You cannot work with markup. You convert markup to margin. So if markup is 50, remember 50 is 50 over 100. So you add numerator to the denominator. So margin will be 50 over 150. That is the margin. Then they say 350 remain. So you multiply with what has remained in the store. So 350 remained times the whole amount was 15. So is that the one bringing 3 million? Or people used 50% direct? Is that the 3 million? Yes, that is 3. Yes, that is 3. That is 3 million. Perfect. Yes. Perfect. 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 All right. So what else? Nothing. Let's. So consolidation hata sifai kuwapeleka, but wacha tu tunapeleke for fun, because already we have said you add W plus X plus F in full. So even there is no big issue, but let's just complete it. So nini sijawaambia kwa disposal, hakuna wakileta mtapambana nayo, there is no big issue. So right there, W group. So W group, consolidated statement of profit, stop loss, and other comprehensive income. Another comprehensive income for the year ended the year ended 31st March 2017. Have that. Higher, so shillings are in millions. So because we know we are adding in full, because we are adding in full, I want you to consolidate for me revenue. Can you adjust revenue? Then you give me the lump sum figure there. Yes, we have agreed. It is the correct thing. We are adding W in full, S full, F full. So can you consolidate then tell me how much? Assuming sasa ni wewe kwa hiyo siku ya mtihani. Mwende 1444. Let's wait for answer from another person. $14.50. Mwende mmeanza kujifa na Hilda. Vera 1444. So watu wamekuwa hapo kwa 144 and 1450 ama. One more person, then we counter check. So let's counter check. It is 976 plus 420 plus 63 minus the goods they sold amongst themselves. So when you subtract the goods ilikuwa 15 million. You subtract in full without bothering profit or what. So you subtract 15. So what will be the correct answer? What will the correct answer be? Jenga, it is the 1444. So people have said it's 1444. Hilda, what were you not subtracting? Because you gave me 1450. What did you not subtract? Or where did you go wrong? Nine. So you subtract the entire. Or 9 million dividends. And let's go to cost of sales. Try that one also. Unajua watu wananiambianga mwalimu hizi vitu zinakuwa nyepesi tukiwa kwa moja, but when you leave us alone they are hard. So let's assume I've left you alone. Just go through it. There is something important about that. You learn to check where maybe you are making the mistake. So can you try and give me cost of sales? Mwende 929.2. Okay. That is Mwende. Someone else? Mwende amepata 929.2. Someone else? Just throw your answers. There is no victimization. Massive 938.2. When I'm meachana tu kidogo. So allow me also to do it, but you just proceed. I want to counter check for my calculator. So Hilda 929.2. Massive, you said 938.2. Mwende was 929.2. Jenga 929.2. Yeah, 929.2 is the correct one. Massive, I don't know. You have a big figure, but let's check. Then you will tell me maybe where you went wrong. So this will be this will be 687 plus 228 plus 26.2. Again, you subtract the 15, so minus 15. Then you add back the unrealized profit of 3. So when you add back the unrealized profit, you are reducing 15 to 12. So 12 is the cost. So that one is coming to 929.2. So Massive, what went wrong somewhere? Meanwhile, give me the gross profit. Gross profit. So gross profit, 514.2. 514.2. 0.8, sorry. 0.8. Then other income. So we have other income. Other income, there is no problem. 6.1. Then there was dividend received. Dividend received. Dividend received. You have to be hapo kuna shida kidogo. There was a note. Check the note. There was a note. Note number 4. Check note 4. On 1st March 2017, F declared an interim dividend of 9 million. W has recorded its share of this dividend as income. So whatever dividend you receive internally, you are not supposed to bring it as income in your books, because at the end of the day, that is intergroup income. So you need to subtract. So you will take the 8.1 minus what they received internally, the dividend they received from the subsidiary. That one you subtract, so that the difference is what they received from external sources. That is what you bring. So the dividend was received from F. In F, parent was entitled to 90%. So you take 90% times those people declared dividends of 9 million. So you will take 8.1 minus what came internally, because this was internal dividends. That one you don't bring in the books. So how much is remaining? How much? Thank you. Zero. Kuna kitu hapo. So the whole dividends came from internal sources. Then there is operating expenses. No. Before I go to operating expenses, we gained. There was gain on disposal. So you need to capture that gain there. So gain on disposal. Gain on disposal of F Limited. How much was it? The consolidated. There were two, but you consider the one which is consolidated. The consolidated gain was how much? 122 point something. Yeah, 122.8. So this is 122.8. That one also you add there. Then operating expenses. Operating expenses. There is no problem there. You just add 68 plus 54 plus 13.4. Then finance cost. Finance cost is 12 plus 18. That is 30 plus 6.2. That is 36.2. How much is operating expenses? Thank you. That is 115, 135.4. 135.4. Therefore, profit before tax. So profit before tax is 514.8, and just back up inside the answer. Thank you. So that is thank you. Answer. How much is the profit before tax? Hapo mmeenda slow. Profit before tax will be how much? Ama kuna mahali mna differ? Because why the silence? All there is a figure here. Or operating expenses. What I'm saying, it is minus source class. So Jenga 472.1. I hope you have subtracted. So this is 471. 472.1. 72.1. Thank you. I will proceed to income tax. Income tax 45, 30, 3.2. That is 75 plus 378. 78.2. So how much is the PAT, profit after tax? So help me the profit after tax. We bring other comprehensive, then we share the profits. $393.9. Then other comprehensive. Other comprehensive income. Other comprehensive, there was gain. Gain on revaluation. Gain on revaluation, we had 15 plus 122. So 15 plus 122 plus 16. 15 plus 122 plus 16. Yeah. How much is that? $153. So total comprehensive income. How much? Y plus 16. When nimeona 16 mahali, ni venye wamepanga vibaya ama. I don't know. Hebu ngoja kidogo. Is there evaluation in the books of F? Hebu help me checking because mine the way it has been arranged. Sasa hii imeandikwa style gani? Well, hapo kuna shida. Hebu check for me the evaluation in the books of F. My paper imelala hivi. I don't see it well. How much is it? Because if we are not keen, tutajikuta kwa shida. So it is 2. Is it supposed to be, or F has no evaluation? Can you check? Now, kama F hawana evaluation, I'm seeing there 14. 14, it should be 2, yes, because I think the typist kuna 2 hakuweka mahali. Muangalie vizuri. Because there is 17.2 minus 3.2, that one gave us 14. Then if 16 is the total, then there is revaluation line somewhere there, which has been omitted. Kindly check, just check kindly. I think it's 2 which has been omitted. Because you are seeing 14, how are they arriving at 16? It means there is revaluation of 2, which I think ni makosa ya mtu to compress hiyo karatasi. So this one should be 2. When I thank you for saying that, that would be 2. It is the arrangement which has messed us up. But it's okay. So it is 15, 12. Oh, okay. Patrick. 12 then 2. So if it is 12, then it means that ile ingine tulikosea. Because this 12, we took it as revaluation when we were calculating the net assets. Patrick, you have guessed, yeah, by the way, because 90 plus 122 cannot give us 102. It is 90 plus 12. Where? Hiyo ni disclaimer tutaweka. We cannot go back to adjust that one. We'll just assume tutaandika note hapo. So it is 15 plus 12 plus 2. That is 27 plus 2, 29. So it means this game, this one here, is not accurate, because if it is 21, if it is 12, then it means the net assets will change. The net assets will change. So, but tutaandika to note, we cannot go back to amend. So 393.9 plus 29. Na Patrick, wewe ni kama ulikuwa unajua mapema. Na hukusema, ulisema wacha wapambane na hali yao. Utapatana hapo mbele. So how much will that be? There is no big, we'll just write a note for it. Thank you for 22.9. Then once you get the total, you share. You share this one, you share the PAT, and you share the total comprehensive, those two, to the parent and minority. So you'll come this side, PAT to NCI, then holding company. They are going to share the 393.9, then total comprehensive to NCI and holding company. They will share the total of 422.9. Have that, then we can start sharing. All right, so let's check the profit which goes to the minority. So let's have NCIs as a working, PAT share. PAT share. So minority, we are going to check in S and in F. So you consider the PAT of those subsidiaries, those two subsidiaries. Check their profit after tax. Check the profit after tax of those two subsidiaries. So those two subsidiaries, we have 90 and 14. 90 and 14. You check three elements. When you want to get PAT to minority and realized profit, you only subtract if subsidiary is the one who sold, eliminating upstream. So in this case, goods were sold by W sold goods, so parent is the one who sold. So the profit of subsidiary is not affected. Unrealized profit affects the books of the seller. So ignore. Impairment, if it is full method, of course, impairment was not there, depreciation was not there. Those three elements are actually what you normally check. So there is nothing. There is nothing which affects at all. Okay. Therefore, minority in S will take 40%, while minority in F will take 10%. Because parent was having 60, so minority will have 40. So 40% of 90, 10% of 14. 10% of 14 is 1.4. What is 40% of 90? 36. 40% of 90 should be 36. Yes, this is 36. Therefore, total minorities profit should be 37.4. So here you bring 37.4. So the parent will take 393.9 minus 37.4. You subtract. So that one is how much? The difference. The difference. 393.9 minus 37.4. Mwende, yes? Mwende, what is the issue? You have raised up your hand.
Yeah, Mwalimu, kindly rudia the NCI for the PAT share for NCI. I nimefloat.
Meanwhile, Jenga is saying 356.5. 56. All right. Then now, total comprehensive. Total comprehensive, you take what they got in their profit. So from profit, they got 37.4 plus what they are going to get in revaluation. So, let me have this one here. So total comprehensive to NCI will be PAT. PAT, they have gotten 37.4. From profit after tax, they have gotten 37.4. Revaluation in S minority will get 40%. 40% of 12. Remember, evaluation was 12. in the books of S. So 40% of 12. Then in F, it will be 10% of 2. It will be 10% of 2. This one here. So they don't take their share in parent. Parents, they're not entitled to. They just got that here and there. So 40% of 12 is 3.2. I'm not sure. Right after. From a 4.8. So, but this one is 0.2. 4.8, yes. So this is 4.8. So the total share will be the addition. So you add. $42.4. 42.4. So this is 42.4. So parents will be 422.9 minus 42.4. Tell me what you are getting. That is the end of that thing. Then maybe tunaweza andika note. Unaweza jiandikia hiyo ulitumia, instead of 12 you used 122. 38.5. 38.5. So you can just write a small note there that in the calculation of net assets of S, we used 122 instead of 12. So if you write that, there is no problem. So it means in exam where there is no mistake, we are just good to go. Good. So let's just stop that thing of disposal at that stage. You know, disposal and step acquisition, the piecemeal, is just the same. The difference is that piecemeal, you consider subsidiary from the date of top-up moving forward. Then disposal from the date beginning of the year up to there. So it's just the opposite. And considering here we have done 3 questions and piecemeal we did 2. Those are 5 questions on almost the same thing. Ikuje kwa mtihani, I don't see what they can mess you up with. The only difficult thing on disposal and step is the period. If you don't capture the period accurately, hiyo tu ndio inakuangusha. Sio concept. Na you want to nasikia mtu anasema mwalimu mimi sijui nilianguka aje because I did. So unapata instead of 6 months umeweka 5 months. Unaanguka hiyo pia ndio karibu almost everything unaanguka. So wewe leo ulianguka aje because unrealized profit ilikuwa sawa everything. So just I rather you take 10 minutes. 10 minutes to analyze the periods properly. When there is disposal or step acquisition, you analyze them properly, then we are good to go. So for now, for the remaining 1 hour, allow me to introduce something new. So do you need a 3, 4, 5 minutes break before we proceed to something else? Or you are okay? Do you need a small break before we go to handout page 8? Joy, 8, yes, Hilda means what? Yes means you need a small break. Or we proceed, you know, because 5 minutes break, sawa jenga. Then let's meet back at 7:55. So let's have a small break. We meet back at 7:55, but make sure you have the handout, page 8. We are going to page 8 of the handout, which is the last bit of that handout. So make sure the handout is there. then we come back. Thank you. So break is over. So I hope the handout is there. Let me get my handouts so that people. There's my handout. So I've assessed you and I've realized you are hata kama mtu hajashika sana, I can say people are around 80-85% in group. So nimeona mmeshinda national, so nawapeleka international. So international is whereby the parent is operating in different, should I call it jurisdiction ama geographical area ama country? Yeah, let me use the word country. The parent is operating in a different country from that of the subsidiary. For example, parent is in Kenya and the subsidiary is in Uganda. So the subsidiary in Uganda, of course, will be reporting in Ugandan shillings, while parent will be reporting in Kenyan shillings. So how do you consolidate? Because even if it is in a foreign land, the parent still retains the control. So how do you go about such scenario? So when the parent is operating in a different country from that of the subsidiary, then during consolidation, you have to translate you translate the operations of the subsidiary to the reporting currency of the parent. So you don't translate parent, you translate income, expenses, assets, and liabilities and equity of the subsidiary to the reporting currency of the parent company. I hope that is clear. So the question will be, how do we translate? Which exchange rate do we use at what point? So that is what we want to check, then we proceed. But before that, let's go to the handout. Let's go to the handout. The objective of IS number 21 is to prescribe how to include foreign currency transactions and foreign operations in the financial statements of an entity, and how to translate financial statements into presentation currency. The principal issue is on which rates to use when translating the operations of a foreign transaction stock entity. Key definitions, so there are some terms we need to familiarize with. One, functional currency. So what is a functional currency? It is the primary currency of economic environment in which the entity operates. The primary currency of economic environment in which the entity operates. Then presentation currency, it is the currency in which financial statements are presented. So to make us understand it better, I normally use the example of kama UN. UN, we have UN here in Kenya, Apagigiri. They normally, when they are in the office in Kenya, kwani wakienda kununua bread, huwezi enda Naivas na dollars to buy bread. Okay, me, I've never seen. They will go with the Kenya shilling. So that Kenya shillings is the functional currency. But when UN will be presenting their financial statement, I've not checked, but I'm sure they cannot prepare their books in Kenya shillings. They will prepare their books in USD. So USD is the presentation currency, while the currency they are using in the environment where they are operating from is the Kenya shillings, which is the functional currency. South Sudan, I think they got their currency the other day, but I'm informed they still prepare the financial statements in USD. So then here in Kenya, Destiny is operating in Kenya. So Destiny is transacting in Kenya shillings and preparing books in Kenya shillings. So it means the functional currency is Kenya shillings and presentation is Kenya shillings. So functional is the currency from where the entity operates. I want to make it simpler because I've seen in before, they are telling students required Roman 1. Also when they bring these foreign subsidiaries, you find required Roman 1 in differentiate between functional and presentation currency. So functional is the currency from the jurisdiction or the environment from where the entity operates, while presentation is the currency you are using when presenting the financial statements. I hope you have understood. Exchange difference, it is the difference resulting from translating a given number of units of one currency into another currency at different exchange rates. Of course, when you exchange, normally there will always be exchange difference. The exchange difference can either be a gain or loss. So exchange difference arises due to the translation of currencies. Foreign operations, a foreign operation is a subsidiary, associate, or a joint venture whose activities are based in a country or currency other than that of the reporting entity. Fine. Foreign operation is just an entity which operates in a different country from that of the reporting entity. For consolidation purposes, the parent company needs to translate the functional currency of a foreign entity to the presentation currency of a parent company using the exchange rates shown in the table below. So you need to master those rates. In exam, examiner will be very rigid. They have to share two rates. So it is upon us to know which rate is applicable at what time. So all income and expenses are translated at average rates. So in the question, examiner, they will tell you the average rate for the year was maybe 4. So the average they will mention. So when you are translating the operations of the foreign subsidiary to the parent, you translate using the average. And I've said the average examiner will tell you, they will tell you average is this. So income and expenses, I just want you to master that. That's what I want you to master. That income and expenses, we translate at the average rate. That is 1. Current assets and current liabilities, we use the closing rates. So closing rates is the rate as at the balance sheet date. The day unaangalia huko chini, when you are told to prepare the statement of financial position, that date you are required to prepare the statement of financial position. When translating the current assets and current liabilities, use the rate on that date. The rate on that date. You see, this is balance sheet issue. So current assets, current liabilities, use the rate as at the balance sheet date. So examine Apple. So in the question, they will not tell you. I've said average, they will say, but closing, they will not tell you this is closing rate. They will give you so many rates. So it is upon you to check when are we preparing balance sheet. Then the current assets and current liabilities, we translate them as at the balance sheet date. I hope that is okay. Then non-current assets and non-current liabilities, you use closing rate or spot rate. Spot rate sometimes is very rare, but spot rate is the rate as at the date of occurrence. Kama ni purchase of building, the rate on that date building was purchased. Otherwise, even non-current assets and non-current liabilities, we just use closing. So to scale it down, all assets and all liabilities use closing rates. Use closing rates. Or spot rates, where if maybe it is provided, kupatia hiyo spot, tumia spot, but spot moja moja. So asset and liability spot closing rate. Closing rate is the rate on the date you are required to prepare the balance sheet. Equity and reserves, historical rates. Historical is the rate which was prevailing when the subsidiary was acquired. You know, equity and reserves, on the date of acquisition. So historical is the rate on the date when the subsidiary was acquired. So ordinary, you know, ordinary, what did they acquire? So they acquire ordinary shares by that time. So equity, go to the rate which was there on the date of acquisition. If once you have those things and you apply it yourself, dividends, spot rate. Spot rate is the rate on the date of occurrence. So the date when dividends were paid, use that rate. So you need to master them. P&L, profit and loss account, average, unless otherwise, average, P&L. Balance sheet, assets and liabilities, closing rates, unless they say spot. Equity, historical, period, nothing much. So down there, NB, closing rate is the rate prevailing as at the balance sheet date. That one I've said. Then spot rate is the rate at the date of occurrence. Historical rate is the rate as at the date when foreign subsidiary was acquired. The end of handouts. The end of handouts. Yes. So maybe what follows is a question. For the remaining minutes, up to 9, we can try a question out. Kwenye 9 tafika nitaachia hapa. Patane jioni. Yote mimi nasikia nimechoka. So April 2022, there was a question on foreign, if I'm not wrong. Maybe somebody can ask you how to recognize foreign exchange difference. Yeah, I've seen it somewhere. How to recognize foreign exchange difference. You know, foreign exchange difference is either gain or loss. Foreign exchange difference should be recognized as part of equity, other comprehensive income. So in case the examiner will how to recognize foreign exchange difference, you just tell them it's recognized as part of equity, as other comprehensive income. But I will check, there's some theory, kuna theory zingine about foreign, kuna ile handout. But I hope nobody joined the class recently who is not aware I gave theory, all the theory questions. There are some theory questions about foreign, wanaletaka vitu tu wanisikia nayo. So I think I captured them in that handout. I hope by now you should have read, you should be in round 1 of reading that handout. So if you are here and you don't have the handout, please make sure you get the theory handout as soon. We'll go through. From that handout, you will get not less than 20 marks questions. Ukisoma thoroughly, maswali zitatoka tu hapo. Tuna mali natoka, just there. So just read that handout properly, then all shall be well. Yes, April 2022 is page number 27. So my students are there, and you will allow me to read. You will allow me to read the question. So you are there. It says, and I read, P Limited is a public limited company listed in the Security Exchange. It has diversified its activities by acquiring S Limited, a company domiciled in a foreign country. Okay. But why do you think people will go for foreign? Mostly is for profit, any profit shifting, which is ukipatikana, ujue hiyo ni criminal offense under income tax, what procedural, what. People will normally go to countries with low tax rates, so that they not even avoid to evade tax. So mostly people do that. I don't know which company was found, but people normally do that with the motive of what we call profit shifting. So that waende huko kidogo watucombine na hii profit iende chini. Both companies prepare their financial statements in accordance with the International Financial Reporting Standards. The presentation currency of the group is the Kenyan shilling, while S Limited functional currency is the franc. So in economic francs, the draft financial statements for the year ended 31st December 2021 are set out below. So, as you guys can see, so P is in Kenya shillings, which is the parent. S subsidiary is reporting in francs. So hata kama ni wewe surely, how will we consolidate this plus this? You must first of all translate the operations of S into Kenya shillings. A statement of financial position, as you guys can see. Let's go to the additional information. Number 1, on 1st of January 2021, P Limited acquired 80% of S Limited, of S Limited's 1,000 million francs one ordinary share for a cash consideration of francs 35.50 million. There's no problem. As at the acquisition date, the carrying value of S net assets was francs 2,600 million, but the fair value was francs 3,200 million. The carrying amount of the net assets was 26, while the fair value was 32. Whenever there is a variation between fair value, you are the people to tell me. The examiner is giving you the fair value of the net assets and also the carrying amount of net assets. Which one should we use? Which one supersedes the other? When you have the fair value and the carrying amount, which one should we use? Can I get from someone? We have fair value and we have the carrying amount. Which one should be used? Just normal accounting. Which one should be used? Correct. We use fair value. In any accounting where you have fair value and carrying amount, always use the fair value. And that the difference between fair value and carrying amount mostly in a quantity revaluation. That is what you need to know. So quickly, even before I move forward, the difference between that 32 and 26 is what serious, revaluation is fair value uplift. The excess in fair value over the carrying value was due to unrecognized brand with a remaining useful life of 5 years. So wamesema, if they don't say, then we just take it as fair value uplift, but they have said the difference between 32 and 26 is a brand, no problem. The non-controlling interest in S as at the acquisition date was valued at 1450 million using the fair value method, no problem. As at 31st of December 2021, it was determined that goodwill arising on the acquisition of S was impaired by 10%, no problem. The following foreign exchange rates are relevant. 1st January. So when did we acquire this subsidiary? Well, the question started, note 1. 1st January 2021. That is when the subsidiary was acquired. So the date on 1st January 5. So 5 historical. That is the historical rate. Historical is the rate which was there when the subsidiary was acquired. So 5 is historical. It will help us when translating the equity. 31st December 2021. When are we preparing the balance sheet? 31st December. So that is the closing rate. So 4 is the closing rate. Then average for the year is 6. So average, that one has been given. Then the rate is francs to Kenya shillings 1. Required, determine the exchange difference, which is a gain or loss arising on translation of net assets and goodwill on acquisition of the foreign subsidiary. So those are 2 questions in one. They want us to get the exchange difference, the gain or loss, that is 1. Then 2, they want us to get the goodwill on acquisition. And they are giving us a hint on gain or loss. They have said gain or loss arising on translation of net assets. So when checking gain or loss on exchange, we check the net assets. You know, net assets is represented by equity. So the increase in equity is what will give you the exchange gain or loss. Then B, consolidated statement of profit or loss and other comprehensive income. Then consolidated statement of financial position. So let's start with Roman 1. Let's start with Roman 1. So Roman 1, which is A. So say A1. A1, exchange difference. Exchange difference. Exchange difference on translation. Translation of net assets. Translation of net assets. Net assets of S Limited. So have it that way. Translation. So you are translating from France to Kenya shillings. So we are going to translate from France. I've seen the shillings are in millions. So right here, leave a space here for narration. So France in millions. Then you can write for me here rates. Then Kenya shillings also in millions, like that. So have it that way. So how will you know that you have gained or you have lost on the net assets? You check the opening net assets, then you add net assets for the year. Then you compare whether it will tally with the closing. You go to, according to serious, check the opening net assets, then add for the year. And for the year, remember net assets is ordinary, share premium, retained earnings, revaluation. So at the start of the year, check all of them. Then you add during the year. During the year, the only thing you are going to add is retained earnings. Ordinary share premium, they remain constant. So you just top up the profit. So when you take the opening plus profit, they should give you the closing. So should there be a difference between what you have added to the opening and the closing? The difference is the foreign exchange. So we start by saying opening net assets. So opening net assets. So opening net assets, that is at the beginning of the year. So you go to January. So in January, the opening net assets, they gave us carrying amount of 26 and fair value of 32. So you pick 32. So in France, this was 32. But on that date, you use the opening rate on that date. So on that date, the opening rate was 5. So translate to Kenya shillings. So this being our first question, I will task you to tell me something. Do we multiply or do we divide? Because hapo pia ukipata wrong, what? Italeta shida. So check for me. Kila mtu amesema divide. How do you know? Unajua mimi sitaki hii kitu ya ku, because I've seen it bringing problem. Imepangwa hivi. Wamesema hivi. France, hapo kwa note number, this note the where the rates are note number 5. France to Kenya shillings 1. That is how they have arranged it. So if you are not sure, it's not only multiplying when they multiply. So if you are not sure, you test. Like the first one, you see they have arranged it this way. Francs to Kenya shillings 1. Francs to Kenya shillings 1. Na hapa chini wameandika 5. So it means the interpretation goes this way. 5 francs is equivalent to 1 Kenya shilling. So you can always check, you can always test with 1. Now, if you test with 1, the entire question you will comply with that. So you can say this: if 5 francs is equals to 1 Kenya shilling, what about 3,200? 3,200 francs. So you divide. So those who are saying you multiply, by the way, to be very honest, I've never seen a question where we are multiplying, but that does not mean it can't be. It can, but from the arrangement, francs to Kenya shillings 1. So 5 francs is equivalent to 1 Kenya shilling. So Kenya shilling seems to be strong. But me, I don't want to check it in terms of strong ability or weakness ability. Where upange hivi, wakiandika francs to Kenya shillings 1, you say 5, even when you don't rate the remainder, 5 francs is 1 Kenya shilling. Therefore, this you test with 1, it will guide you. So for those who are saying you multiply, I hope you have seen we are dividing. So you divide in order to come to Kenya shillings. I hope you have understood. Hiyo mmeelewa. Na mimi sijaiona swali wana multiply. Unless kuna swali ilikuwa ya kitambo, si 201. A long time ago. But nowadays we sawa. So good. So in exam, kama uko sure is you counter check, but most utapata ni division. Wanna pretend that the Kenyan is strong. So 32 divided by 5. 32 divided by 5. What do you get? For the net assets, are we using historical rate or closing rate? Net assets, you see the way we have said, opening net assets, opening net assets. So opening, you use the opening rate. So opening net assets at opening rate. Opening rate is at the beginning of that financial year. Sometimes unapata 31st December and 1st January. So 31st December and January are closed. So when we are not checking historical, closing or something, this is just opening net assets. So opening net assets at the beginning of the year. So 5 imekuwa historical because it's a coincidence. That is the date when subsidiary was acquired. So 5 is historical, yes, but we are using the opening. I check it in terms of opening, not. I hope umeelewa. So at the beginning of the year. At the beginning of the year. So how much will that be? How much will that be? When you translate, when you divide, what are you getting? People are getting 640. So you get 640. Thank you. Then you add profits for the year to the net assets. You know, net assets is just the ordinary share capital, share premium, retained earnings. So the increase, what increases net assets is profit. So you start with, to get the foreign exchange difference, start with the opening, top up for the year. Then we are going to compare whether they tally at the end of the year. Massive, is the 1st January 2012 an error instead of 2021? Oh, yeah, it's an error. It's an error on there. I don't know on whose side, but it's supposed to be 1st January 2021. Yeah, it's an error. It should be 2021, not 2012. 2021, yes. So profit for the year, can you check for me the profit for the year for S? I want to see whether you can capture it. Can you check for me profit for the year for S? Tell me how much you are seeing. How much are you seeing the profit? Whether yes, 1,500. So profit for the year for S is 1,500, but there is something small we need to adjust on that profit. Check note 2. Check note 2. Because we should not translate mistakes here, we have to rectify. Check note 2. At the date of acquisition, the carrying value of S net assets was 26, but the fair value was 32. The excess in fair value or the carrying value was due to unrecognized brand with a remaining useful life of 5 years. So there is amortization on that brand. There is amortization on that brand, which we need to subtract from their profits. So I don't know whether you can do it somewhere outside. Brand is equals to 32 minus 26, which is 600. That is the value of the brand. So amortization, amortization will be 600 divided by 5 years. What is 600 divided by 5 years? That is 120. So there is amortization, annual amortization of 120. So profit for the year should be 1,500 minus that amortization of 120. Yeah, it should be like that. 1,500 minus amortization of 120, that one will give you 1,380. So profit for the year, which rates do we apply to translate the profits? I want to see from someone. Which rate are we using to translate that profit? Lamuntu 6, thank you. Being the first question and we are in order, that is good. So profit for the year, you use the average. So take 1,380 divide by 6. Divide by 6. $230. So this is 230. So up there, 230. So you add to it now, add exchange. So I don't know whether it's going to be an exchange gain or loss. So just right there, add exchange something, leave it blank there. I don't know if it's going to be a loss or a gain. So the exchange gain or loss will be here. It will be there. So now you add 3,200 plus 1,380. What do you get? $32 plus 1,380. That one comes to how much? 32 plus 1,380 is 45.80. So it means closing net assets is 45.80. So can you translate this 45.80 at closing rates? Closing rates is 4. So can you translate 45.80 by 4? You're to pay closing hapa. What do you get? 45, 80 by 4, 1145. 1145. So it means when you add, when there is no exchange gain, no exchange loss, then this plus this should give you 1145. If it tallies, then it means there is no foreign exchange gain or loss. If there's a variation, then there is a gain or loss. So 640 plus 230, this is 870. So when we add opening plus during the year, we are getting 870. But when we translate closing as lump sum, this one here, when we translate the lump sum amount, we are getting 1145. It means there is an increase. So the increase is a foreign exchange gain, which is the balancing figure. The balancing figure. So how much is the gain? 640 plus 230 net from 1145. 275. So this is 275. And that is it. So with that you get 3. And how do they mark? How do they mark the 3? It is 1, 2, 3. Those are what the examiner will mark. Those are what the examiner will mark. Good. So just for formality, itatusaidia huko mbele, you say you can allocate. So allocation to parents. Parent will take, in this company, parent was having 80%. So parent will have 80% of the gain, 275. Then minority, non-controlling, will have 20% of the 275. It will help us ahead as we progress. So what is 80% of 275? What is that of that? How much you distribute to them? The parent will take how much of the gain? The foreign exchange gain? To 20 and 55. To 20 and 55. So this one will just help us ahead. What I want you to understand, have you understood how to calculate the foreign exchange gain? What you do is simple. Check the opening net assets. There are some questions they can fail to give you the opening, but in the question they will give you the ordinary share premium retained earnings. Add all of them. So for the net assets, just add the equity. Not at the date of acquisition, but at the beginning of the year. You know, it can be acquired 3 years ago, but here we are talking of opening. So opening is at the start of this year. So you bring the opening net assets, you translate at the opening rate at the start of the year, then you add a profit for that year. If there is something to be adjusted, depreciation or something, you adjust. So you add a profit for that year, you translate. Then after that, add the opening plus the profit, get the figure, then that figure, which is now the closing. You know, opening plus profit during is the closing. So translate the closing at the closing rates. Then compare with what you translated here. The difference is foreign exchange gain or loss. When you revise once, itakuwa sawa. Our next question I hope it will be okay for us. Let's calculate goodwill. Let us calculate goodwill. Let us calculate goodwill. So that is 3 marks. Goodwill will carry another 3 marks. So A2. So A2, goodwill. Goodwill on acquisition of S Limited. Goodwill on acquisition of S Limited. I think once we're done with that, we can stop there. Then consolidation, ikuje jioni. All right, so here again, we have France. So what you do, and listen to this, for goodwill, just calculate goodwill in foreign, the entire goodwill. So don't translate everything during calculation. Just calculate up to goodwill in foreign, then translate the goodwill. So calculation, you calculate up to goodwill, then translation starts from goodwill. Ukienda one by one, you will be wasting your time. So be there. All right, let's start. So purchase consideration. Purchase consideration. Check additional information number one. Consideration was 35.50. So I'll say goodwill, let's just calculate first up to goodwill, then we translate. Then add fair value of NCI. Add fair value of NCI. NCI is mentioned in note number 3, 1450. 0005. I hope that is 5. That is 5. I hope so. Then we less the fair value of net assets. So less fair value of net assets acquired. Fair value of net assets acquired, which we said now we take 32. We take 32. So be up to that point. So now, goodwill on acquisition. Goodwill on the date of acquisition is 1800. That is 18. So translation should start from here now, because in our books, remember what we are interested in is goodwill. So goodwill is what we are supposed to translate. So easy to translate that because we are not going to use them anywhere. What we need in the balance sheet is goodwill. So goodwill 18. So can you translate that goodwill using which rates? Can you check which rate can we use to translate the goodwill? I'll be happy to see that rate. Which rate are we going to use to translate goodwill? 4. 4. I disagree. It can't be 4. Yes, immaculate 5. Yes. You know, this is on the date. This is goodwill on acquisition. So when you're using 4, already we're at the end of the year. Goodwill is computed on the date of acquisition. So on acquisition, the rate was 5. So you can't use 4. If we have 4, we made at the end of the year. So use the rate of 5. So what is 18 divided by 5? 18 divided by 5, what do you get? So good, that is 360. So here people are getting 360. So that was our goodwill on the date of acquisition. But remember, now I think that's why some people are saying 4. Remember, goodwill is assessed for impairment. So from acquisition up to the end of the year, you check. If goodwill is impaired, you reduce. If it is not impaired, then perfect. Balance sheet will show the 360. But there was impairment. Check note number 4. As at 31st December, close of the year, it was determined that goodwill arising on acquisition of S was impaired by 10%. So less impairment. Impairment loss. So impairment loss, they have said 10%. So it is 10% of the 1800. 10% of 1800, that is 180. But remember, impairment is an expense for the year. So expense, you translate using the average. So average is 6. So this one you translate at 6 because it is an impairment. It is an expense. Income and expenses we take at average. So how much? 180 divided by 630. Yes, that is 30. So you subtract 30. So whatever you are translating, any moment you translate anything, there will always be foreign exchange gain or loss. So even on translation of goodwill, we have to check whether we gained or we lost on translation. So here you will come and say, foreign exchange. We don't know whether it's going to be a gain or loss, so we'll leave it for now. We don't know whether it will be a gain or loss, but now here, you tell us the closing goodwill. So closing goodwill. Closing goodwill, you will take the 1800 minus 180, then you translate now. Those people who are saying the closing rate of 4, now it is that one. So 18 minus 180 should be 117, 1620. 1620 plus, yes, that is okay. So this closing goodwill, translate it now at the closing rate. Closing rate is 4. So 1620 divided by 4, what will you get? That is 405. So when you translate, you get 405. So if there is no gain, no loss on translation of goodwill, this minus this should give you 45, which is not true. 360 minus 30 is 330, but closing is showing us 405. So there's a foreign exchange gain of how much? So this is a gain. Gain, the BF is the balancing figure. So there is a gain of how much? 75 Jenga. There's a gain of 75. Gain of 75. So how will you get the 3 marks? Where's the 3 marks coming from? 3 marks are here. Determination of goodwill, the impairment, and foreign exchange. Those are the only things the examiner will mark. There is no need for me to lie to you. Those are the only things the examiner is bound to mark in that question. So allocation to parent. Parent will take 80% of 75. NCI will take 20% of the 75. How much? How much? How much? How much? $60 and $15. 60 and 15. Those are, they will help us ahead, Isonga. So that is how we calculate foreign exchange gain on the net assets, which is from operations, and also on goodwill. So I want to stop at that stage because we can't do P&L now, so that when we meet in the evening at 6, we do the profit and loss account, then we do the statement of financial position. We check if we can start another question to Achane and I are free. Otherwise, for now, we have to stop at that stage. So you can practice. Kama utakuwa na time before jioni, just practice again how to get the two gains, the rates, how to play around with the rates. Otherwise, it is not hard. Have a blessed Sunday. We meet in the evening.